Hey guys, welcome back to All Things Buying a House. I'm Celisa James, and I have with me, as always, Taylor Nevitt.
Hey guys.
Sorry we missed a week. It was kind of crazy with Memorial Day weekend and just everything going on, but we are back, and today we are going to talk to you about why mortgage brokers are better. So I am a mortgage broker. Taylor is currently getting licensed so that she can also become a mortgage broker. She's working on getting her real estate right now, and then she'll get her MLO or NMLS, which is your loan origination license, next. Unfortunately, she's getting pushed back because of COVID.
Yeah.
So it's taken a little longer than we would have liked, but no big deal. So we're just going to talk about what the difference between being a mortgage broker and a bank and what we call retail is. So I'll kind of just get into it and just start explaining to you the differences between the three, and then Taylor, I'm sure, will ask questions along the way, and we'll answer as much as we can. But I want to let you guys know why it's always better to use a mortgage broker if you have that option. So to begin, you have the banks, and Wells Fargo, Chase are some of the bigger ones, Bank of America, USA, things like that. So those big banks, their loan officers don't have to get as many licenses as a mortgage broker does. So the bank is the one that takes the liability for all of their employees. And they basically, when you go in and you ask for a loan, the bank just gives it over to whatever loan officer they have. Most of their loan officers are not just loan officers. They're usually both loan officers, and then they also work on some of the banking side as well. And so that's what they do. So their main goal isn't necessarily to bring in the loans. The loans are usually given to them, and then they kind of work them from there. So retail, which is what I used to do, those are corporations, and what a retail company does is they get the loan and they go through the whole process like we do, but they fund their own loan. So they supply the money for that loan, and then they take a bunch of loans at once and they sell them off. So they don't do what we call servicing. They don't service their own loans. They sell them off to investors in big chunks. And then the investor, you guys might know, like Mr. Cooper, or off the top of my head, I can't think of any more at the moment. But then they are the ones who hold your loan and send you your monthly statements, and you pay them and they service the loan. You call them for problems, not the loan officer that you went through for retail.
So would they not be able to do like government loans, like VAs? And
they can still do all the same loans, as long as they're approved, of course. Yeah. Everybody has to be approved. But they can do government loans. Sometimes they have like specialized loans that are just their company. We call those portfolio loans. And it's what it sounds like. It's a portfolio, so their company holds it. But yeah, they can do all the same loans for the most part that we can, except, like I said, they supply their own money to fund the loan, right, and then they sell them off at the end. A mortgage broker is an actual person. So in our case, it's Sharon Nevitt. She is our broker. She has gotten her broker's license. It is a third license that she received. It's a lot more hours, a much bigger test, and you have to be 2 years full-time in order to get that and obviously pass the test. So she has a broker's license. She is able to open her own company, which is our company, Pacific Coast Mortgage Group. And she, my license, or my two licenses, because I have my NMLS and my DRE, my licenses are under her license. So as my broker, she holds the liability for me as a loan officer. So if anything gets messed up or is wrong, it falls under Sharon as the broker, and she owns the company. Now, what's really cool about a mortgage broker is that we get paid directly from the banks. So we are able to work with multiple banks, and we can get any type of loan that they have, any specialized loans that they have. We can do hard money loans, which is where you have a private investor who decides to give somebody a loan because maybe they couldn't qualify for a regular loan at a higher interest rate. And usually those are short terms, but we have the option to broker out to these different places for these different loans. So that's kind of the main difference between the three. Now, what's also really cool about a mortgage broker is, so we work with the banks. The banks love us because we don't cost them anything. We basically are selling them, right? We're bringing them the loans, and then they're paying us for the loans. So we sometimes get better deals than even their own loan officers get. A lot of big banks have what you call a net branch, which means that loan officer works for that specific bank, and they're retail. And then we wholesale to that bank. So they offer us different rates. A lot of the time our rates are a lot lower because they don't have to pay for our office, our overhead, our bills, anything like that. That's covered under our broker. So we're much cheaper for them, and we just are bringing them constant business. So we get a lot of perks from that.
Which is cheaper for the buyer.
Exactly. Because in this scenario, the buyer doesn't pay us. Right. The bank pays us. We're commission. Basically, we're just commission. So every loan that we do, we receive a percentage of a commission, and that's paid directly from the bank to us. The borrower, it does not pay any of that cost. Whereas if they went to that same bank's net branch, they're going to have to pay a portion or a cost for the loan because the bank has to account for overhead and employees, salaries and things like that. So that's a big difference, it's really good for us. And it's why I love brokering so much, having come from a retail side to a broker side. The other really cool thing about brokers is a lot of banks and retail places, they have overlays. So we all banks, retail and wholesale locations, we all go off of the Fannie Mae and Freddie Mac guidelines, which we've talked about before. So those are the two big companies that basically write all the guidelines. For all the loans, all your funding requirements, everything comes from them. So as a bank or a retail location, a lot of the times what will happen is you will have guidelines. Then on top of the guidelines, they will have particular overlays for their specific bank or retail location that Fannie Mae and Freddie Mac don't have. So I'm just going to use an easy one. So let's just say that Fannie Mae, you're getting a conventional loan and your debt to income ratio cutoff is a 45, right? So as a wholesale, I go directly off of that Fannie Mae guideline. That's what I do. All of my loans too would be that 45% DTI. I know I can't go over that, but anything up to a 45, I'm going to get through the underwriting process. Well, a retail location or a bank will have an overlay. So they'll, in their head, say, we're funding our own loans, we're providing the money for these loans, there's too much risk in this. We're going to put an overlay in place that even though Fannie Mae says you can go up to a 45, if you get a loan through our bank, you can't go over a 43% DTI or debt to income ratio. That's what an overlay is. Yeah. And they have a lot of those. Again, coming from the retail side, I remember a lot of the time we would have loans and we would have some crazy overlay that was specific to our bank and we couldn't do the loan and it got really frustrating and the loan would go somewhere else and that other bank could do it because they didn't have that same overlay.
Yeah.
So as a broker, we have the options. If we are going to one bank and they have some weird overlay that we don't agree with and doesn't work with our loan, we just go look at another bank because we have those options. We can sign up with as many banks as we want. We have everything from the big giant banks like Quicken and United Wholesale Mortgage and Caliber, down to the smaller banks like Angel Oak, who does non-QM, which is it's not a regular Fannie Mae Freddie Mac loan. It's a different loan. And like I was saying earlier, we can work with private money investors as well. So we have a lot more options for our borrowers, and we can find a home for almost any loan for almost any borrower. So that's a really big plus to using a mortgage broker. Plus, your mortgage broker is local. Most mortgage brokers, they're not huge companies. Sharon's company, there's only the three of us that work here. You have Sharon, you have me, and you have Taylor. So you're really going to get that top-notch quality service, and it's going to feel like, you're at home with us. We're not some big paper pushing bank or company where you're just another number to us. We really like to get to know our clients. We have a lot of repeat clients because we have such good relationships and rapport with them, and we're in touch with them every single step of the way. So you get I feel like you get a much better quality service when you use a broker versus just going to the bank and literally just being another number. I know some banks, they offer like a lower rate, but you have to open up an account with them and have, like $50,000 in that bank account in order to get that rate. Yeah. So we don't do that. We're not going to make you open a bank account because, one, we're not a bank, and two, we're not going to make you put, $50,000 of your own money into that account just to get this rate. We can get you those rates without having to do that, which is really nice. Another cool thing about a broker is with our compensation. So like I was saying, the bank pays our compensation. That is called lender paid, which means the lender, the bank, pays us. We have another option for rates. So if you come to us wanting to buy a house, and we, for whatever reason, especially now with COVID, this has happened a few times where we were really locked out of a lot of rates because all the banks throughout everywhere just cracked down on their rates and their guidelines and stuff. There were some loans that we weren't able to price the regular way, which is lender paid. This is going to get a little complicated, guys. I'm just going to forewarn you. It's not really something you necessarily need to know, but it's something just to know. It's another option that we have as a broker. We can do what's called borrower paid. So the way that a borrower paid loan works is that you as the borrower, you're going to pay the compensation. It's not going to be as high as we have it with the bank. It's going to be a lot less. You're going to see what it is. So it could be like one origination point, which is 1% of the loan amount, or it could be like 1.5. But the way that we're going to do it is we're going to look at the rates. It's going to be a different set of rates when we go borrower paid. And the way that we try to do it is we find a rate that works for your loan. We've had to use these when we were super tight on their ratios or things like this, and we had to have that lower rate. So we look at their rates, and they tell us that a certain interest rate is going to give a credit back to the borrower of whatever amount. Let's just say the credit back to the borrower for that specific rate is $4,000. So the borrower is going to get $4,000 towards their loan and closing costs. What we do is then we will take what we are going to charge for our compensation, and we're either going to match that so they cancel out so you're not paying for it, or we might make it a little bit more because, let's be real, we are running a business. We have to make money somehow. Yeah. It could be a little bit more, but you're only going to pay what that difference is. So if the credit's $4,000 and our charge is $4,000, they cancel out. You're not paying anything, but we're able to get you that lower rate. If the credit's $4,000 and we're going to charge $5,500, then you as the borrower are only paying $1,500. It's still so much cheaper than going to a bank or going to a retail. A, they can't offer that, and B, a lot of the times, a lot of like the retail locations, they charge their borrowers points for the rate that they quote them or give them, and they're usually quite a bit. It's usually like 1 or 2 points. So we are able to cancel out that cost by giving you that credit back. So we don't do that a lot. It's